Another advantage or another financial reward that a business trying to integrate will have is a better or stronger balance sheet. When you are integrating with another business, the business is coming, business A will be coming with its own resources in terms of assets. Business B will be coming with its own resources in terms of assets. So assets of business A, assets of business B coming together will make both assets to become stronger. And also that could all increase their cash flow. So that is another financial benefit during integration. And the third one, lower cost. Integration will help to exploit economies of scale. We already talked about economies of scale, which is what? A cost reduction as a result of expansion. So integration is also expansion, but what type of expansion is it? It is an inorganic growth or inorganic expansion. Is it clear, please?
Yeah.
All right. So that's the third one. Then we go to the risk. No, yeah, the fourth one. Yeah, we go to the risk now. What are the financial risks of integration? Number one. Oh, I didn't say one. I forgot one, which is lower taxes. With it, let me quickly talk about lower taxes before we go to the financial risk. With integration, there's likelihood that a business integrating will pay lower tax because the operation of company A or business A is coming together with the operation of business B, which means they will be paying taxes under the same name, and that would definitely reduce the taxes they pay. That is another advantage or financial reward for integration. So now we go to risk, which is financial risk of integration. Number one, the integration cost. What do we mean by integration cost? Here I wrote, the process of integration can be very complex, time-consuming, and expensive. When during integration, it does not really happen just in a day. It takes a lot of time before it happens. Different negotiation will occur. People would need to talk. It is time-consuming and it is expensive. It's not something. It is very, very complex. It's not something that everybody will reach a compromise immediately. So as a result of that, it is a cost. It is considered as cost for the business. Is it clear? Let me cite an example. Yeah, let me cite an example. During integration, remember one of the advantages of integration is that the workers already have the skills to operate in the market. Yes or no?
Yes.
All right. So if business A and business B is coming together, for example, school A and school B coming together, definitely school A will have its own business teacher and school B will have its own business teacher. So it might mean that they would only need a business teacher. So definitely one business teacher would be made redundant. So to make that business teacher redundant, you have to pay a redundancy fee, which is a huge amount of money that has to be paid because you are making that worker, that business teacher to be redundant. So which is also what? A cost for the business. Do you understand what cost is now?
Yes.
Great. 2, overpayment. When I talk about overpayment, here I wrote, this occurs as a result of underestimating the cost of integration and overestimating the financial benefits. What are we saying here? If business A wants to buy business B, business A could pay more in buying business B because business A has overestimated the financial benefits it could get. Business A could think, oh, if we buy business B, we're going to have more customers. If we buy business B has a very good position in the market. We could have, it could better our position in the market, which might not be logically true. So this means you are overestimating the financial benefits of taking over business B. As a result of this, you overpaid the acquisition fee, or you underestimate the cost of acquisition. You might think, oh, business B doesn't have a lot of liabilities. It's easier. Oh, business B, it doesn't have a lot of workers. It is easier for us to take over. Not knowing that they have little workers, but the workers they get huge amount of salary, which is unknown to you. So you have underestimated the cost of acquisition and overestimated the financial benefit of acquisition. So this might make you to overpay for the acquisition. Do you understand? Do we get what I'm talking about here? Overpayment. Overpayment occurs when the business that is taking over another business overestimated the financial benefit of acquisition and underestimated the financial the loss or the financial risk that is involved in the acquisition. That is overpayment. The third problem about integration, which is also a risk or financial risk, is bidding wars. There will be auction. Whenever a business that has to be taken over has a lot of potential buyers, has 2 or more potential buyers, this would increase the fees they have to pay in acquiring such business. So that could lead to auctioning. Do you get what I'm saying here?
Yes.
I'm talking about bidding wars here. The third one, bidding wars. Bidding wars means auction. If business A wants to be acquired, but business A has a lot of potential buyers, this could make the price of acquiring business A to become higher, and that could lead to auctioning. So which is another financial risk. And when there's auction, it means you might pay more than what you wanted to pay. You might pay more than what you have budgeted to pay in acquiring the business. Is it clear? Is it clear, please?
Yes, sir.
So we go to the advantages of inorganic growth. So for inorganic growth, we already know what it means. It means integration, the coming together, integration through merger or acquisition. So for the advantages of inorganic growth, number 1, speedy growth. What do we mean by speedy growth? Here I wrote, businesses can grow far more quickly through mergers and takeovers than growing organically. Through organic growth, the business would grow gradually because you don't have to use other business resources. You are using your own resources. So it means there's going to be a gradual process or gradual growth for you. But when you are integrating, the growth process will become so fast and quicker because the resources, you are going to use resources of other businesses with your own resources. And that is expanding beyond even your control. Is that clear? Is it clear, please?
Yes, sir.
Speedy growth means integration would allow a business to take different resources to boost its expansion. 2, strategic benefits. When I talk about strategic benefits, I wrote, a business can fill gaps in its product portfolio very quickly by making acquisitions. The strategic benefit is this. Whenever you are acquiring or whenever you are integrating, a business A would have a separate business product portfolio. Business B will have a separate product portfolio. So integrating product A and business A and business B together would boost your business or your product portfolio, which is also an advantage. That's what we meant by strategic benefit in terms of the product portfolio. Is it clear?
Yes.
Yeah. The third one, economies of scale, which is not new anymore. Inorganic growth will mean that a business is expanding. And what comes with expansion? Benefits, cost reduction. So a business that has come together with another business will definitely have a reduced cost, a reduced average cost, which is what we call economies of scale. So here I wrote, integration allows a business to witness cost reduction almost immediately. For organic growth, if you read the note of yesterday, we said with organic growth, economies of scale will come but it will come in the long run. In the short run, the business might still face some difficulties in terms of cost. Please, are you with me?
Yes, sir.
For organic growth, there will be economies of scale, but it will be in the long run. But in inorganic growth, there will be economies of scale almost immediately. That is the difference between economies of scale in organic, economies of scale in organic. For organic growth, economies of scale will come in the long run. For inorganic growth, economies of scale will come almost immediately. Is it clear?
Yeah.
The fourth one, eliminate competition. So when I talk about eliminating competition, here I wrote, inorganic growth can help to reduce competition in the market. There is business A, business B, business C, business D in the market, in the industry. But business A and business B are coming together. That means the competition in that market has reduced to 3. Do you get it?
Yeah.
Before now, we have business A, business B, business C, business D in the market. In this market, business A and business B have come together to become one. So the competition is now between business A and B, that is 1, business C and business D. So it means 3 in the market in terms of competition. Is it clear?
Yes, sir.
So another advantage about integration is that it reduces competition. So go to the problems of inorganic growth or disadvantages of inorganic growth. Number 1, market regulator or regulatory intervention. Here I wrote, market regulators might have interest in the integration process, which may delay the integration. During integration means 2 or more businesses are coming together. But because they are coming together, market regulators might need to be sure that they are coming together is not to form a cartel, or they are coming together will not be disadvantageous to customers. As a result of this, it might take a very long process. With them, they might need to be sure that they are coming together will be beneficial to the society. So they want to be sure about everything. So this might take a long period of time before they get convinced about the integration, which is a problem. Do you get it?
Yes, sir.
Okay, that is regulatory intervention. Two, drain on resources. Here I wrote, mergers and takeover can cost a lot of money. Merger and acquisition, they are not cheap. It takes a lot of money. It doesn't come cheaper. The company that wants to sell will not just sell. It will sell for its own benefits. Yes or no?
Yes.
It's just like the transfer market in football. Players want to go to other clubs. The club will come up with its own price. The buying club will come up with its own price. That means the supply will come up with its price. The demand will also think about the price. But at the end of it all, the supply will think further. The supply will be sure that whatever it's paying, it's what is right for the price. Is at the right price. Do you get it? Are you with me, please? Are you with me, please?
Yes.
All right. So there will be drain on resources, which means it is expensive to merge or to acquire. The third one, culture clash. Business A and business B, they have, irrespective of whatever stage of production they have, they might have the same stage of production, but they don't have the same culture. Their way of practicing are different. So coming together, there might be need to impose a different culture, which might lead to conflicts. That is another problem of integration. Do you get what I'm saying here?
Yes.
Business A has its own business culture. Business B has its own business culture. So coming together, they might need to impose culture on one another, which might become a conflict for the business, might become a conflict, which might also lead to failure for the business. Is it clear?
Yes.
And the last one, the alienation of customers. Here I wrote, companies might be too focused on the process of growth and neglect the needs of customers. Because you are focusing more on expansion, you are focusing more on integration, you forgot that your customers are the kingpin. So you forgot the needs of your customers, which might make you to lose these customers. Do you understand?
Yes, sir.
You might be so big that you forgot to always even listen or seek information or feedback from your customers. You become so bigger to think about your customers. This is what we meant by the alienation of customers. The alienation of customers. So the business is more focused on expansion, that it forgot the needs of its customers. So these are the problems of integration. Is it clear?
Uh-huh.
Is it clear? Is it clear, please?
Yes, sir.
All right. So I'm quickly going to recap because time is up already. I'm quickly going to recap. We're talking about inorganic growth. And when we talk about inorganic growth, it means it means integration, which is through merger or acquisition. Then we have merger, which means the coming together of business A and business B to become business AB. That is merger. And we have acquisition, which means the purchase of one business by another, which is business A purchasing business B to become business A. That is acquisition. Is it clear? Is it clear, please?
Yes.
And what are the reasons for merger and acquisition? One, for exploiting synergies. And when you talk about synergies, synergies means a whole is greater than the sum of the parts. A whole is greater than the sum of the parts. So here we're talking about you coming together as a business to become more powerful, more efficient than being separate as a business. Business A and business B coming together to become stronger than business A or business B. That is what we mean by synergies. Synergies. Do you understand what synergies is now? Synergies means a whole is bigger, powerful than the sum, the addition of the parts. Business A and business B have come together to become so powerful than what business A was or what business B was. That is what we mean by a synergy. Is it clear? Is it clear?
Yeah.
All right. Two, it is quick and easy way to expand. So when you want to expand in a very quicker way, it is better you use an inorganic growth. Because when you use organic growth is a gradual process. It takes time before it reaches the highest, before it can reach the apex. But inorganic growth, it is right now, because you are having different resources coming together. But for organic growth, it is just your own resources, your natural resources that you have to use to expand. For example, your retained profit. So your retained profit cannot be as much as the combination of retained profit of business A and retained profit of business B coming together. Is it clear?
Yes.
The third one, some businesses have cash available, which they want to use. So another reason why there is integration is that business A has a lot of money that it doesn't know what to use it for. So the best way to use it is to acquire business B, to finance business B. Is it clear? We're talking about the reasons for integration. And the fourth one, mergers can take place for defensive reasons. When we talk about defensive reasons, it means I am buying business A, I am taking over business A so that I would have less competitors in the markets.
Uh-huh.
Do you understand defensive reasons here? It means
Yes.
I am buying business A so I can have less. I am buying business A so I can have less competitors in the market.
Okay.
And the last reason why there is merger or takeover is because of globalization. Businesses might want to integrate so that they can operate their business and sell their product worldwide. That is the first thing we talked about merger and acquisition. Do you have any questions about it?
No.
So that's all about the lesson.
Okay.
Any question?
No, not really. It's all clear.
All right.